If I told you one company grew its revenue 65%, posted a record $215 billion in sales, and still controls roughly 81% of the market, and its stock was up only about 4% this year, you'd think I was lying to you. But as of late June 2026, that's exactly what's happening with Nvidia. Meanwhile, AMD, a company with a fraction of that market share, has seen its stock climb roughly 144% since January. Same industry, same AI boom, same headlines, completely different outcomes. And that gap, right, there's an entire AI valuation debate in one chart. So let's actually break this down, because most of what you're hearing about AI stocks right now is either fear-mongering or cheerleading. I want to show you the real numbers, what they actually mean, and where the genuine risk is hiding, because it's not where most people are looking. First, the headline. As of the end of June 2026, chip stocks just closed out their best first half and their best quarter on record. Not best in 5 years. Best ever, based on the data available at the time of this recording. But inside that record-setting rally, the two biggest names in AI chips are telling two completely different stories. Nvidia finished its fiscal year with $215.9 billion in revenue, up 65% from the year before. Earnings per share jumped 60% to $4.77. According to research firm IDC, Nvidia controls roughly 81% of the AI accelerator market specifically, not GPUs overall, not every chip segment, but the AI accelerator category where Nvidia's hardware actually competes. That's still close to a monopoly in that specific lane. And yet, as of late June 2026, Nvidia stock is only up about 4% year to date. Now compare that to AMD. AMD's first quarter revenue came in at $10.3 billion, up 38% year over year. Their data center segment, the part of the business selling AI chips to companies like Meta and OpenAI, hit a record $5.8 billion, up 57%. Strong numbers, no doubt. But AMD's stock didn't go up 38% or even 57% to match that growth. As of the same date, it was up roughly 144%. So here's the question. Why is a company growing 38% up 144%, while the company growing 65% is only up 4%? Part of the answer is valuation. Part of it is something else, and I'll get to that in a minute, because it matters just as much. As of late June 2026, Nvidia trades at about 21.6 times forward earnings. Many investors would consider that reasonable, even attractive, for a company growing this fast. Though that's a judgment call, not a universal rule, and value-focused investors might still disagree. AMD, on the other hand, is trading at roughly 71 times forward earnings as of the same date. For AMD stock to grow into that valuation and trade at the same multiple Nvidia trades at today, AMD's earnings would need to more than triple from current levels, roughly 3 1/3 times, just to match where Nvidia already sits, not even grow beyond it. Now, to be fair to AMD bulls, markets price future growth, not just current growth. If AMD's MI 400 chip lineup ramps as expected and inference workloads, meaning running already trained AI models, not training new ones, keep expanding the way analysts project, AMD's earnings growth rate could accelerate faster than Nvidia's over the next 2 to 3 years. That's the actual bull case, and it's not irrational on its face. The question is whether a 71 times multiple is the market correctly pricing that acceleration or overpaying for it in advance. We got a preview of what happens when that bet gets even slightly questioned. On June 5th, 2026, the entire chip sector got hit with one of its worst single trading days in years. The Philadelphia Semiconductor Index, the benchmark tracking the chip industry, dropped 10% in a single day, the worst one-day move since March 2020. According to market data reported at the time, the sector lost roughly $1.3 trillion in value in that one session. What triggered it wasn't a recession or a Fed announcement. It was Broadcom's earnings call. Broadcom actually beat expectations on revenue and earnings for the quarter they just finished. But their guidance for the next quarter, their forecast for AI chip sales going forward, came in at $16 billion versus an analyst estimate of $17.2 billion. a miss of about $1.2 billion. Not even on what they'd already earned, but on what they expected to earn next. That single forecast miss helped trigger a $1 trillion-plus sell-off across the sector. That tells you something important. This market isn't pricing these companies on what they've delivered. It's pricing them on what they're expected to deliver next, with very little room for error. Now, the part most bear case videos skip over. The demand behind this isn't fabricated. Hyperscaler AI spending, meaning capital expenditure from companies like Microsoft, Google, Amazon, and Meta, is estimated to reach roughly $650 billion in 2026. That's real infrastructure being built, real chip orders being placed. And separately, analysts have estimated that Nvidia's future AI demand pipeline, based on customer commitments for its upcoming Blackwell and Vera Rubin chip platforms, could approach the $1 trillion range across 2026 and 2027 combined. Though it's worth being clear that figure comes from analysts and industry estimates, not a number Nvidia has disclosed in an official filing. So the demand side of the story is grounded in real spending, not just sentiment. But real demand doesn't automatically mean every stock riding that demand is fairly priced. That distinction is the one most people miss. There's also a fair question a sharp viewer might ask. If Nvidia is a cheaper stock with a bigger market share, why hasn't the market bid up more? Part of the answer is that Nvidia already ran up enormously in the prior 2 years before this one, so some of that growth may already be reflected in the starting price. Another part is that investors may be pricing in slower growth ahead as the AI build-out matures, or simply rotating capital toward names that look more like an early-stage story. None of that proves Nvidia is mispriced. It's just a reminder that cheap relative to a competitor isn't the same as guaranteed to rise. It's also worth naming what the script hasn't covered in depth. Competition is real. Hyperscalers like Google, Amazon, and Microsoft are building their own custom AI chips. Google's TPU, Amazon's Trainium, Microsoft's Maya, and over time that could chip away at Nvidia's dominant position, even if it doesn't threaten it today. Export restrictions on advanced chips to China remain an ongoing policy risk that could affect both companies' addressable markets. And Nvidia's valuation leans heavily on maintaining very high gross margins. If competition or pricing pressure compresses those margins, the multiple the market is willing to pay could shift quickly. So is this a bubble? Here's the honest answer. This is a 1999.com scenario where companies had no revenue and no real plan. These are real businesses with real, reported, record-breaking revenue. Nvidia's $215.9 billion in sales is not vaporware. But a valuation imbalance doesn't require fake businesses. It just requires real businesses getting priced for a future that has to go nearly perfectly. When AMD needs its earnings to more than triple just to justify today's stock price, while Nvidia, the company still dominating the AI accelerator market, trades at less than a third of that multiple, that's a meaningful gap. It might be fully justified by AMD's growth trajectory. It might not be. That's genuinely something reasonable investors disagree on. If you're holding either of these stocks, the lesson isn't sell everything, and it isn't buy the dip blindly either. The lesson is to know exactly what you're paying for. With Nvidia, you're largely paying for revenue and market share that already exist. With AMD, you're paying a much higher price for revenue that still has to materialize over the next 2 to 3 years. Those are two different bets wearing the same AI stock label. And in a market that's sensitive to a single quarter's guidance, knowing which bet you're actually making is the only thing that matters when the next earnings call doesn't go exactly as planned. If this kind of breakdown is useful, subscribe. We're going to keep tracking exactly where the real numbers diverge from the hype.